running. So
We'll make up time. Thank you, Bill. Thank you, everyone.
yeah, no. I typically take a moment to explain this slide, but I'm not going to in the interest of time. Let's just keep going through these.
Interesting. Yep. Jeff did this. Okay.
Yeah.
Quick one
So,
about Hartman.
Just a quick intro on Hartman. We are an independent IT and business advisory firm. We work with businesses and nonprofits to help organizations get the most value out of their technology and M&A investments. I guess the three best words that describe us is strategic. We're very focused and passionate about driving profitable growth. So that's top line, it's bottom line, as well as improving the use of working capital. We're trusted. We take our confidentiality agreements very seriously, particularly around M&A, but as a general practice, we're considered a trusted partner by our clients, many of whom have been with us for multiple years, and in many cases, since our founding in 2004. And then independent. We are a truly independent advisory firm. We don't benefit financially or otherwise from recommending a solution provider or a partner at all to our clients. So independence is very important to us. And when we make a recommendation to a client, it is singularly focused on their business and their business needs, and not about our relationship with a vendor of any kind. On the M&A front, let's keep going.
So Bill, I'm happy to take this. So, really what we've done is we found a way, the importance of IT in today's day and age and how it has accelerated into visibility in the C-suite. COVID, it would have gotten there anyway, but COVID certainly accelerated that. But what we're seeing now is blending our IT with our transaction execution expertise in order to make sure that you have that clients have a smooth and flawless M&A framework and delivery and execution, and importantly, realize the value from it. And we have familiarity with all types of deals, whether it's stock, asset, simultaneous sign and close, window between sign and close. But just some of the key headlines in terms of what we'd be looking at is, as I mentioned, whether it's an integration, a diligence, a carve out, a transaction management, kind of what we call the X, with X being a variable MO office, so an IMO, a TMO, a DMO, separation management office for carve outs, focusing really on day one readiness, 100-day plan, day two cutover, all of that leading to value realization. An important point of that would be synergy achievement. And also really getting to a vision for future state plan. Obviously, when the, hopefully and likely when the transaction has been contemplated by buyer, they have a future state vision of how that business can add value to their overall enterprise. And that's all about future state plan. Really begins happening once integration is winding down, but integration is planned with a vision for future state. And really important, helping to understand the support that's required from a seller post-close. If you're on the buy side in terms of receiving TSAs and reverse TSAs, or if you're on the sell side and you have to deliver TSAs or RTSAs. So I'm going to turn the next slide, unless anyone has questions. Okay, so this is the first survey question. Denise, if you could pop it up, please.
So you guys know who we are. We want to know who you are. So help us understand kind of which side of the M&A transaction you guys have been most involved with.
I don't know what's going on with Zoom, you guys, but answer the question in chat while I try to figure this out.
And we're sharing my screen, Denise. I'm not seeing that, so we'll leave it with you to capture the chat.
Hold on a second.
That's okay. Everybody's responding in chat, so it gives us an idea of what where people are on the continuum. Looks like we've got a good distribution. All right. Did everybody get a chance to answer the question?
I think
All right, why don't we, I think that's about what we're gonna get. So it did look like there was a pretty good distribution of experience, everything from buy and sell to both, and plenty of nones. So with that, we'll we'll make sure we explain any acronyms that we use in the future. This way we don't take those things for granted. Let's go on. So as you guys may know, the M&A activity since 2020 hit. Gary?
Yep. You
Did
see
we
the
have
screen?
PowerPoint? No.
I don't know what happened to share screen. Are you seeing it or no?
No.
All right,
Is anyone seeing it?
let me go back and see what happened.
Just go to PowerPoint.
Yeah. Back.
Presentation mode, please. Thank you. All right. So since 2020, as I mentioned, the M&A activity has been really strong, with the peak happening in 2021. As you can see that as we get into the first quarter of 22, the volume has dropped off, as has the deal value. So let's move on to the next slide. By no means suggests that the M&A market is dead. But if you do look at, the deals and the types of deals, it's clearly what's driven this, that, is consumer services, technology services, finance. Those types of deals in those industry sectors have slowed down quite a bit. If we go to the next slide, in terms of the deal count, the deal value, you see that the deal values come down too. And this is in large part driven by the decrease in the number of large M&A deals. And so the average deal value came down as we move from the large transactions to more middle market. Now, if you look at this list, it looks very similar to the list from the previous page where we've got finance, technology services. So in addition to having the volume shrink, the value of those deals have fallen pretty significantly. We move to the next slide. But the middle market's hot, guys. The middle market for M&A is really hot, and it's been driven in large part due to the amount of dry powder that PE firms still have. And in addition to the PE firms, there's a number of growth-minded middle market organizations that are at that inflection point of do we grow or do we exit? And for those that want to grow, they're using M&A as a real lever. Now, that's not possible for everybody because COVID impacted the balance sheets of a lot of middle market firms, much more so than the large organizations who have plenty of buffer to run their businesses. The other notable thing here is that the volume and the value of those deals has stayed pretty constant. So it's an exciting time to be a middle market advisory firm. We see a lot of activity in this industry and in this space. And we think that this will likely continue through the balance of 22. Next slide.
Yep, which is another polling question.
So as we kind of look at this question again, let's use the chat feature and there it is.
It's working.
There it is. We got it working. All right. So what
Up
do you
and running, guys.
What do you see as the primary reason for acquisitions failing? Based on what you've seen, or if you haven't, I know there are a number of people who haven't been a part of M&A. What's your hypothesis about why deals fail? And I'll remind you that your CPE credits are tied to these responses. We only have one answer right at that right now. Oh,
No, I'm seeing about 14 folks have come through.
okay.
Yeah, I think we can proceed now.
Yep, there you go. I was a little bit slow it was a little slow getting to my PC. So, okay, next slide. I think what we learned was that, the vast or a significant majority of you thought it was the wrong strategic fit.
Right.
And that is certainly, in our experience, a key driver here. And we'll talk about how the role that strategy plays and diligence plays in the planning process, the planning and execution. But certainly overpaying is an issue, particularly now. We're at this dichotomy where sellers are really thinking their businesses are worth much more, right? Pre-20, pre-19, they're thinking pre-COVID valuations, when the buyers are thinking well, not necessarily so, right? The world is a different place. And so we have this situation where buyers and sellers start off the discussion in pretty at opposite ends of the spectrum in terms of valuation.
So just building on that, where the preponderance of folks answered was wrong strategic fit. When you have a wrong strategic fit, you're kind of starting from behind the eight ball. It's on an uphill climb. So it also will lead to diligence misses because you don't necessarily know the strategy. And if it's a wrong strategic fit, you could be looking. Overpaying is clearly something that, as we've talked about. But the other one that's important to mention is integration, especially if you're trying to integrate a company that has a wrong strategic fit. Even if you're integrating a company that has the right strategic fit, that's a challenge. And we often see many deals fail because of integration. And we'll talk about that later in the presentation as well. So let me just close that, and which leads into this, Bill, if you want to continue it.
Yeah, sure. As you know, there's plenty of research around deals failing. And when you consider all the work that's been done over the past couple of decades around, why deals fail. 10 years ago, we talked a lot about culture, but we still have 60% of the deals failing to deliver on the value envisioned at close, post diligence at close. So that's a pretty alarming number. And when you look at the work that BCG did, almost 80% had no integration plan. Over 60% had no technology plan. 70% had no synergy plan. And 82%, over 80% lost 10% of their acquired workforce. Now, there's one thing if the intent is to rationalize resources and downsize the organization. But what we're seeing is because of the three things above, it's adding significant pressure onto the most talented elements of your organization. And that's where the churn is happening. That's where we're losing people on the high performance end. Denise, can you go on mute, please?
Sorry about that.
And then, as I alluded to just a moment or two ago, the caution here is that the integration plan really needs to incorporate the deal strategy. What's the strategy behind this acquisition or what have you, the type of transaction? What's the rationale behind it? What's the business value for it? As well as the diligence findings. So we go through diligence and we have all these observations. If the integration plan doesn't marry those two issues together as it builds out the plan, that's where you're going to get the lowest success rate in terms of value realization. So as we look at risk, these things are all risks, and these are things that you can mitigate, that you can plan against. Gary, you want to flip the chart?
Yeah, so, and just building on that, and we talk about integration plans. Planning is just so key in anything. I mean, we've had, I think it was even I forgot who said it, but a famous quote around having no plan is a plan to fail. It could have been Benjamin Franklin.
Ben Franklin.
Yeah. So that, but the point is that we need, acquirers and even divestors need a carve-out plan on the divestment side or an integration plan on the acquiring side. It's critical to have that plan in order to have a roadmap on where you're going to go to realize value.
So, coming out of COVID, we're finding that several middle market firms, in fact, a lot of our clients are finding themselves, either predator or prey. Are they out there looking to grow through M&A and look to buy organizations, or are are they being approached by others? You know, do they have balance sheet issues or growth challenges that, perhaps they serve a niche market that, or they have a specialty capability that makes them attractive to another buyer. So we see coming out of this period and continuing through 2022 and potentially beyond, the majority of middle market companies are talking to people. They're talking to people about, selling their business or buying other businesses. There are very few on a percentage basis that are just kind of same go forward, keep it going basis, at least in my industry. All right, so what can we do to mitigate risk and to increase value realization through this complex process of M&A and really avoid the pitfalls, the common pitfalls that we see? We're going to go through a series of 3 case studies. And these are done a little bit tongue-in-cheek, admittedly. The first one, selling is easy, buying is hard. There are a number of organizations that in particular think that it's a lot easier to sell your organization than it is to buy one. They think about all the diligence that goes into buying a company and understanding the financials, where if you're selling, all you have to do is give the information you want and receive the check. So we'll talk about an organization that pretty much thought that selling was easy and buying was hard. The second anecdote or case study we've described as M&A is easy if you've never done it. And so there are a number of organizations, middle market organizations, that have just not participated in either the buy or the sell side of a transaction. And frankly, it's really easy if you don't know what's involved. And in fact, these are the deals that have the highest risk, because most of the executive teams don't understand that even though you're a middle market firm, you really have to go through this process, that there is a method to follow through this transaction. There are frameworks that you can use to help de-risk these deals. But, even if you're talking about $1 million transaction or a $5 million transaction or a $10 million transaction, most middle market companies can't afford to lose that money. And so, every deal is important, and they're never as easy as you think they're going to be. And then finally, the third deal, we're going to share. The third case study is, we describe it as separate the deal makers from the integration team. We'll talk about why that's a challenge and some of the implications for doing that. But, we do have clients that pursue this approach and this philosophy, and invariably it creates substantial risk to the enterprise.
So Bill, building on one headline that you just mentioned about smaller deals may not necessarily think they need a framework. Quick story. I was talking with an attorney once, and his view was actually the smaller the deal, the more it's needed, because actually there are more material items because the deal size is smaller. Whereas if you're in a larger deal, you get the 1, 2, 3, 4, top 5 value drivers. That's going to get you 80% of the way there. On a smaller deal, you have many more material aspects that need to be addressed in order to actually achieve that value.
Thanks, Gary. Okay, so on the selling is easy, buying is hard front. There's an organization, a middle market energy company, on the upper range of middle market. Arguably, they could be described as outside of the middle market range, but they were a large organization. They were divesting 2 of their primary assets, and they had 2 buyers identified in August. So they knew roughly who was going to be buying these assets. And the close plan called for close on both sets of assets. And by assets, I mean, these are fairly large businesses, right? Very distinct, uniquely different businesses. And the close plan was scheduled for 12/31 of 21. We heard about this in, kind of the November timeframe, so shortly before close. And Gary and I had a quick discussion, and we posed the question, well, is this an asset or a stock deal, to the CFO? And the CFO just kind of got quiet and said, well, I suppose we should have answered that question a long time ago, because he didn't know the answer. And so they had to go back and as a leadership team, talk through those things. That's the kind of basic questions that, we would help our clients understand. And not having a clear view on whether it's an asset or a stock deal is that's a material decision and has a material impact on the nature of the transaction and the diligence required. The other thing is that they didn't have an IT carve-out plan. It was something that we ultimately helped them with, but their systems, even though these businesses were very different, they shared IT systems. They shared the platforms, the applications, they shared their technology. So that created, separating that is a little bit like separating conjoined twins. I mean, it's a very delicate surgical process, right? It's not something you can just hack away and say, okay, you take these and you take those. It was a very delicate process for getting the IT environment separated. Further complicating it was that the seller did not want to provide a TSA. They were adamant, did not want to have a transaction services agreement whereby they would provide the service to the buyer for a period of time. That gave the buyer that would give the buyer the opportunity to either adopt the technologies that the seller had, or to go and invest in new technologies to support the business directly. So that TSA is a really useful tool as a means of facilitating the transaction completion, but they did not want the liability, I'll say, of being able to, of the necessity to provide a service back to these buyers.
Additionally, they were transferring employees as part of these deals, so they were not going to have the physical bodies or the physical capability to actually provide the service. So we had to help them come up with a creative workaround, and Bill will take you through that in order to have the buyers receive transition services.
Yeah, so as Gary mentioned, our workaround was where buyer one of asset one would acquire all of the assets in the IT assets, and then they in turn would provide the transaction services agreement to buyer two, rather than the seller, which is a very traditional way of doing it. It's a very typical way of doing it. The seller providing the TSA. In this case, buyer one agreed to take the assets and the people associated with the IT environment and provide that service back to buyer two. The complication here and I guess one of the biggest risks is that they didn't have a transaction execution process. And as a result, we still don't have a final close date. We know roughly it's going to be Q3 22, but like any deal, time is never on your side. And so the more issues that crop up, the more time that these things are delayed, the more risk to the deal gets introduced. So, again, being able to have a process, a plan, a methodology, and an approach, what really does help de-risk you in these transactions.
And on a very practical level, one of the things I learned early on, and quick joke is, while I have my MBA in finance from NYU, I like to say I have my MBA in deals at J&J. And one of the things that I learned very quickly on is every day that a deal doesn't happen is a greater likelihood that will typically go stale or just not get done. So speed is really, really critical in closing transactions, as Bill was saying.
All right, so let's go to case study number 2. So this is a buy-side client. It's a merger of equals. And so remember, this is M&A is easy if you've never done it. It was an asset deal. And while it reduces the risk of the regulatory reporting, financial, tax, and legal, it creates greater risk on the operating fronts, because you've got to integrate these assets, or you have to disposition these assets in a certain way that makes it more complicated. The cash in, cash out process hadn't been considered. and you really do need to understand, like, this is another one of those basic concepts. You have to understand your cash in, cash out process, really to understand, to avoid the risk in the business,
Yeah,
as you
and
post-close.
And again, in an asset deal, very different than a stock deal, right? Asset deal, you're not getting the bank account, stock account,
Right.
stock transactions you are. So very, very different here. That's why we'll talk about frameworks and what matters in terms of deal structure.
So another big issue was the folks in the know on the buyer side, didn't know that the seller's disclosure schedules had to be reviewed, which was another problem that added time and time to the deal and created more risk and expense to the buyer. There was no synergy realization plan. This is a merger of equals. And typically when you bring two companies of equal size together, there are synergies. There's overlaps in either markets or customers and products. And you have to have that synergy plan to know functions, right? You think about back office functions, accounting, finance, HR, IT. Those things have to be rationalized. So the other issue was that there was no real alignment between buyer and seller on the tax PPA. They hadn't, they wanted to do a simultaneous sign and close. But, no one talked to them about that. They wanted to do a simultaneous close on day one, but nobody talked to them about the option of creating time and separating that process. As a result, when you do a simultaneous sign and close all on day one, your readiness, you have to be ready to operate. You have to be fully ready to go. If you're not, again, there's a huge risk to your operation. Again, didn't consider a formal TSA, right? It was a good faith handshake. We're gonna run this thing on a handshake, and which it can work. It usually does not. And then finally, the organizations relied way too heavily on legal teams rather, to make business decisions. The legal team is there to help protect you on legal issues. The business terms have to be resolved by the business, and anytime you put your legal firm, your legal partners in the decision, the business operations, the business decision-making process, you're going to add time, complexity, and risk to this. We have to let the business leaders make the business decisions. And then finally, separate the deal makers from the integration team. We have a client now that is a software reseller. They have been growing. They're very, very acquisitive. They started acquiring firms back in 2021 as first timers. Multiple acquisitions in 2021 with no integration plan. I mean, they described it as we have a 1,000-page playbook that no one had ever seen. Diligence was very narrowly focused on finance, right? These deals are typically run in this organization by the CEO, the CFO, and the head of M&A. And so they were very financially oriented, but they missed on some of the key IT, cybersecurity, and operational diligence items, which again, these are major areas that represent significant risk to any transaction. Diligence must be done in these areas. And we'll talk about what the outcome of some of this was. The diligence that was done on IT, while we say it did lack the operational rigor, there was the company that was doing the acquiring was acquiring a company about the same size in a different region. And that the company that they were acquiring had invested a significant amount of effort, energy, and financial resources in building out a capability to let their sales force know where they were on commission payments, which in this industry is really important for your salespeople to know how much money they're going to make. Basically the philosophy was, well, we're buying you, so you're going to use our software, you're going to use our systems, and they cut out, their sales organization was much bigger at the target than it was at the buyer, and so they missed out on a huge a huge capability, which created a lot of churn. I'm not going to go through all these, but we talked about some of those risks, and we talked about regrettable personnel losses. We advised the executive team that based on what we're seeing, they were subject to this kind of risk, this regrettable personnel losses, and the regrettable losses are your leadership team. These are the people that while you're out there buying companies and throwing them over the wall and saying, okay, guys, just integrate those. Well, if they're trying to run a business and do integration of equals, and doing that multiple times a year, your people, your leaders, your talented resources were the ones who took it on the chin, and that created a significant turnover problem. And so, we look at things like, were there plans for diligence, integration, and communication? No, they didn't. It was, here's where we're going, and please catch up, stay up, keep current with us. And they didn't define in advance what the business model was and the IT operating model. And so when you start acquiring companies, you have to know how that operating model is going to work. And so we're going to bring this, company A into my company. We need to make sure that the technology environment's defined and that the processes are defined, as well as all the business operations and the business processes. As a result, they had huge delays in integration, added costs, inefficiencies, and greater risk.
And loss of value. Only because
Yep.
one of the other opportunities that you have as an acquirer is best of breed. If you do this in a methodical fashion, you identify through diligence, you actually get learning around what should end state look like, where you can adopt best of breed. And if you're acquiring a company, it's not only for top line in today's day and age, it's also for all the capabilities that they have. And that's part of the strategic fit. You don't want to lose out on that if by not understanding what they bring to the table.
So what are the lessons learned, right? The lessons learned are, M&A is not easy, right? And it doesn't matter how big the deal is. It's just not easy. You do need to be methodical about it. You can't just have a group out buying companies and throwing it over the wall and being disconnected to your operations and saying, okay, guys, integrate it. We're going to go out and buy more. While the growth is certainly admirable, you need to bring these organizations and operations closer together so that the handoff between buyers and integrators is smoother and de-risks that transaction. Next slide.
So, which is we're going to go to a polling question. All right, we'd be very interested in hearing from the audience what they see as the biggest challenges. So right now we're back to a tie for diligence and integration, which is very interesting. I'm not surprised. We're not surprised that target identification did not come up as a major issue. People are in the business, they're in the industry, and they really know what targets would be good. Diligence and integration, absolutely. Day one readiness, interesting. And that speaks volumes to what we talked about earlier on the simultaneous sign and close versus a window between sign and close, that type of deal structure. All right. And also, because of majority of middle market companies may not require a competition authority approval, Hart-Scott-Rodino here in the US, other places ex-US, there is the possibility to do simultaneous sign and close, which a seller will always push for. Buyer has to be prepared as to why that won't work and why a window between sign and close is going to be smoother for the customers, the vendors, the employees, importantly. But yeah, diligence and integration, which are really, we can talk about some frameworks for those, why those will not work as well.
Okay, let's see if we can pick up the pace here, Gary.
We're moving right into the frameworks. All right. So what we've done here is this is a newly appreciated approach with the increased visibility and really importance that's been gone since day one. And what I mean by this approach is leveraging IT's awareness and expertise cross-functionally. But you can look buy side, sell side, stock asset deal, and on a legal entity versus a carve out, and really the complexity on that, high to low. And what's interesting is you have a risk parameter here, or risks that are diametrically opposed between buyer and seller. So one example of that would be on a stock deal, way less risk for sell side, way more risk for buy side. So we'll go through that. So now if you take a look here at a buy side stock deal, it's simplest, as I mentioned, for buy side. However, it comes with significant risk for the seller. And I am, let me just move this let me move this window out of the way so I can see everything. Okay, sorry about that. Key attributes, we're not going to go through every one of these, but I'll do them quickly. Minimal change, diligence is on liabilities. Generally don't need a TSA, but you will have board leadership changeover. Change of control requirements, more so than assignments, because there's nothing being assigned. So it simplifies your diligence process and your day one process to a certain degree. But you do have very much retention issues on not only because it's a stock deal, but just in general. You'll need a new delegation of authority, and you have increased tax complexities because you'll have stub periods for both companies because the same company is owned by two different owners during the course of the year. Now, so what are the key risks? Synergy and value realization by not integrating the target. So if you don't integrate the target, you're going to miss on that. And clearly, because you have diligence, so you're taking on liabilities. And it was interesting because we saw diligence is a key reason why deals don't work. Diligence misses, especially on liability. And you have increased financial risk due to liabilities transferring. Some key opportunities you have day one readiness, which we've heard a simpler day one readiness because business as usual continues. And then integrating the business is elective. Stakeholders may prefer this approach. However, the fact that it's elective, if it doesn't get done, then you're losing out on value and synergy realization. Feel free, folks have questions, put them in the chat, and Denise, Maria can monitor it and raise any questions that come up. We can address them afterwards. We'll try and get through this in time. So again, on an asset deal, way more complex for a buyer, also more complex for a seller because the entire business isn't transferring. Okay, it's a heavier day one readiness effort, which we talked about. There is generally post-close support required from the seller. And interestingly enough, as a seller, do you really want to be supporting a business you just sold? So, we like to say in TSA world, today is the best day of service you're ever going to get. It's only going to go downhill from there. Each day is the best day. Each next day, I should say. There's significant transition activities that have to happen. Communications require a more complex explanation of the transaction. A deeper understanding of cross-functional interdependencies is required prior to close, simply because you're not getting everything that comes with it. So you need to know how the business has been supported and making sure you get it covered in the TSA. Integration value realization is more challenging because you're getting pieces. And then you're going to have potential retention issues in any deal, but probably even more so here, especially if in a stock deal, if people have equity, if it's not transferring and so forth. Employees and customers just may want to not be part of a new company. So some of the risks we talked about day one, readiness, key customers, employees, you got to make sure they transfer the deal. The diligence on this is really, really important. And, clearly, I won't say less so, but it doesn't rise to the same level of focus in a stock deal because you're getting everything. And for the outside third parties, nothing really is changing. Synergy and value realization, if it's poorly integrated, you're not going to achieve those. And you're relying on a seller to continue to provide support to a business that they just got out of. That goes back to what you said about every day of service being the best day and each next day only deteriorating. But the good news is you're acquiring only the pieces of the business you want. You have decreased financial risk due to liabilities not transferring. And diligence is simpler because you're not going to be diligencing liabilities. When we look at sell side, it is clearly the simplest simplest structure for the seller. And it's a smoother structure for employees, suppliers, customers, any regulatory bodies. Again, because the legal entity is not evaporating. The business and the licenses are staying with the legal entity, and it enables, and the seller then enables the buyer to integrate on the buyer's own timeline, and the seller really doesn't have to be part of it. Some of the key risks, though, if there's, any diligence misses could lead to a reduced sale price. If the buyer is finding things in their diligences, diligencing the entire legal entity that were not found in reverse due diligences, and reverse due diligence work by the sell side, you don't want to be at that C-suite when the buyer comes back with legitimate rationales why the price should go down and the multiple should go down. It may also limit the pool of interested buyers. Some companies just don't want to take on and won't take on legal liabilities and won't take on a stock deal. They just want the assets. And also then the seller, really this business that they've built and created is just not, there's no personal, financial, or any other ties to it once it's sold. And that is sometimes an emotional feature for the seller to get out of. But the positives for it is that it's a simpler, it's less day one readiness activities for sell side. They're not going to be providing or certainly reduced TSA support. And all the issues and the challenges post-close clearly rest with the buyer. So again, this is what we talked earlier about. There's a dichotomy of, depending on which side of the transaction you're on, and depending on what your goals and ambitions are, what your risks and opportunities are going to be. So the final one is clearly most complex for both sides. It's a carve out. So seller has a lot of work to do to carve out that business, including potentially doing a sell side carve out QV, as well as the buyer then is buying only a portion of the business, and they're going to be relying on sell side support, and they need to make sure they got everything for the business that they need to. So as we talked, key attributes of this deal structure, it's a significant effort significantly more effort for the seller. Stranded costs, which we hadn't mentioned, will likely occur. You think you're trying to push all those costs with the business, but there'll clearly be some overhead and maybe some shared costs that are stranded that you have to deal with. This TSA service provider, now you're a service provider to business you no longer own. And you could miss some RTSA, some reverse TSA. So if people are going with that business that have been providing support to other elements of the organization, sell side needs to make sure they're getting the reverse TSAs that are needed. And there's going to be a significant conversation around which of the talent pool is transferring, being part of transferred employees. The buyer is going to be looking for key employees and really, best of breed talent. And seller's going to look to retain them. And there are greater implications to third parties on both sides by doing a carve out. It's complicated. It's more difficult to explain in stakeholder communication. And that's so that is pretty much, we've talked about the risks. The opportunities, though, is you shed only the business you no longer want as a seller, and you get greater focus on the retained business. So we'll leave this with you. This is an example of a framework and a process that really just starts with M&A identification and with an M&A plan, going through deal development, transaction progression, integration, carve out and planning, carve out execution, and future state and continuous improvement. What's important here is that they bleed into one another and they're not unique and isolated. So these are the items that are in a plan in each of these buckets. Given time, we're not going to go through them now, but you'll have our contact information. Feel free to call us. And the biggest difference that I do want to touch on real quickly is similar in an asset deal, but in a simultaneous sign and close versus a window between sign and close. You have this bucket compressed: transaction prosecution, integration, transaction progression and integration and carve out and planning all happens concurrently for day one readiness. That's when the integration and carve out execution begins. So you sign and announce it, sign, close, and announce on day one. But right here, this is two buckets in a window between sign and close, the left being transaction progression, the right being integration or carve out planning. And right now it's all compressed into one. Creates a greater need for confidentiality, much more work on the team. It's an important distinction to understand if sell side comes forth with a simultaneous sign and close. So last survey question we have to do is, if we can do that survey question real quick. So where we're seeing results come in, it's about 2/3 formally established cross-functional team and 1/3 engage outside merger integration experts. We certainly hope those that are establishing a formal team are those that have done this before and not first-time acquirers. Again, you don't know what you don't know, and you know what we always find is doing a debrief after the transaction and lessons learned is beneficial for future transactions. So with that, we'll just pause with any quick questions.
Yeah, again, if you have any questions, you want to put them in the chat, or you can just raise your hand, and we can address those. We can address those now. So you guys are all on mute, just in case. All right.
Okay.
Well, we appreciate, thank you everyone for taking the time to join us today. Again, apologies for the startup issue. Really glad to have you here. I hope you found this helpful, useful, and educational.
Thank you again for everyone for your time. And our contact information can be made available through FEI, or it's just at Hartman Advice, first initial last name at hartmanadvisors.com.
Thanks, everyone.
Thank you.